intriguing week for macroeconomic news awaits us, especially from the perspective of the UK, with the latest monthly updates on inflation, government borrowing and consumer confidence due on Wednesday the 20th, Thursday the 21st and Friday the 22nd respectively. It's probably too early for the budget to have any impact upon the first two, but it'll be interesting to see if consultants GfK make any comment whether Rachel Reeves' first policy package as Chancellor of the Exchequer is affecting how consumers see their prospects and those of the country more generally. We've also got a busy week for company news, with 5 FTSE 100 firms and a good selection of small and mid-caps due to release full or half-year results or a trading statement. Of the FTSE 100 quintet, Diploma reports on Tuesday the 19th, Severn Trent on British Land on Wednesday the 20th, but it's the other pair who may make more headlines. They are Imperial Brands on Tuesday the 19th and Halma on Thursday the 21st, and that's because a lot of attention will focus on their dividends in particular, albeit maybe for different reasons. As I sit here, Imperial Brands is the 11th highest yielding stock within the FTSE 100 index, according to analysts' consensus dividend forecasts, while Halma is nurturing one of the longest dividend growth streaks within the benchmark index, one that dates back all the way to 1979. Imperial Brands' own dividend growth streak started with its flotation in 1996, but that ended in 2020 when the company cut its annual payment by a third to 137.7p a share. The tobacco giant has, however, since managed 3 consecutive increases, and analysts are looking for a 4th straight advance in these full-year results for the 12 months to September 2024. Some of that, at least, is down to the 5-year plan laid down by Chief Executive Stefan Bomhard when he arrived in 2020. These numbers cover the 4th year of that plan, and any guidance for the fiscal 2025 will cover the 5th and final one. Intriguingly, Imperial Brands shares trade at a 5-year high. For this fiscal year, Mr. Bomhard expects low single-digit percentage sales growth with a mid-single-digit percentage profit increase on an adjusted currency basis. The earnings advance is second-half weighted, despite an ongoing decline in cigarette volumes, but should be helped by lower losses from the portfolio of next-generation products or NGPs, such as Blue, Pulze and ID, where sales rose by a 6th year-on-year in the first half. Analysts currently expect for the full year a 5% drop in stick volumes to 187 billion, flattish sales at £8 billion, helped by higher prices and market share gains, as well as higher sales from NGPs to £221 million compared to £229 a year ago. Group adjusted operating profit of £3.9 billion, pretty much flat, and adjusted earnings per share of 295p a share, up from 279p. Should Mr. Bomhard give any guidance for fiscal 2025, analysts currently expect a 4% drop in stick volumes, a 15% jump in NGP revenues, broadly flat group sales at £8 billion, and a 9% increase in adjusted earnings per share to 321p, held by lower costs and a lower share count owing to ongoing share buybacks. Finally, from Imperial, analysts expect a dividend of 153.3p a share for the year just ended, and 161.1p for the year just begun. The company's already outlined plans for a £1.25 billion share buyback in the new financial year, the 3rd straight annual scheme worth over £1 billion. Now, shares in Halma aren't far from a 1-year high, although they sit around a 5th below 2021's all-time peak. The FTSE 100 members are a company that provides a solution to a problem. Its hazard detection and life protection systems, locks and devices help companies meet regulatory requirements and keep staff, clients and customers safe. The mandatory nature of investment in this area creates consistent business flows and sticky customers, a combination that can give Halma a degree of pricing power. That in turn can mean high margins, good returns on capital, strong free cash flow, and a growing dividend for investors over the long term. And it's Halma's dividend history which could again write a few headlines this week. The company's increased its annual distribution by at least 5% for 45 straight years, and analysts expect this year to offer the 46th such advance. The current consensus is for a 7% hike to 23.05p a share, so that sets the benchmark for this set of first half results for the 6 months at the end of September. A year ago, Halma's interim dividend was 8.41p a share. September's trading update featured no shocks, and for the full year to March 2025, Chief Executive Mark Ronchetti has guided to good organic constant currency revenue growth and an adjusted operating margin of 21% compared to 20.8% a year ago. More strategically, watch out for updates on acquisitions, where Halma has already announced 4 purchases for the year to March 2025, 2 in the UK, and 1 apiece in Portugal and Spain. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.